right, it's time now for Hot Picks. Today we are focused on the restaurant sector. I hope you're not hungry because this segment certainly will make you hungry just thinking about those meals. McDonald's, of course, is in focus, and we talked about how this is very interesting to see the reaction. A company that beat expectations across the board, saw double-digit same-store sales growth against difficult comparisons, but warning about its margins. What does this say about how investors are feeling about restaurant chains right now? Let's bring Nick Setyan. He's an equity analyst at Wedbush. Joins us now to talk hot picks. Let's start with McDonald's. Are you surprised by the reaction that McDonald's is getting on the back of what looked like pretty solid results, save for a little bit of weakness in their margins?
Yeah, well, thanks for having me, first of all. I'm not overly surprised. I do think that there's quite a bit of focus on inflation right now, and margins is where that gets reflected. And so, there was a little bit of hope that, the peak inflation is behind us, and that, 2023 could see better margins. And, McDonald's didn't really give investors what they were hoping for. So now that they're talking about mid to high single digit food and paper inflation in the U.S. in 23 versus, mid-single digit-ish type of expectations. And they expect another mid-teens type of inflation in Europe, again, in 2023. And so that's really the bottom line.
And I believe that you'd rather stick with another restaurant chain, or believe that could be better insulated, and that's Wendy's. How does Wendy's contrast with your view of McDonald's?
Well, there's three main reasons, right? So number one, again, we talked about mid-teens European inflation for McDonald's. Wendy's does not have much European exposure at all, even though they just entered the UK market. But essentially, it's primarily domestic and Canada. And so, I expect more sort of the mid to high single type of inflation, and not the mid-teens type of commentary that McDonald's talked about for Wendy's, number one. Number two, there is a big valuation difference between the two in terms of, 18, a little over 18 times for McDonald's in terms of EV/EBITDA on my 23 expectations, and 13.5 for Wendy's. And Wendy's pays a 4.7% dividend, right? So I think it's also a little bit safer as well if you do want to be defensive this year, which I do.
And so Wendy's has, the shares have certainly held in, and I want to contrast that with one of your other top picks in the sector, which is Domino's Pizza. It's come off well from its peak a year or two ago. Is this a turnaround story? Does this potentially have more upside? What do you like here?
I really like Domino's positioning in terms of the relative value player that it is, right? I mean, so when everyone else is taking the types of price increases that they're taking, Domino's could still advertise a $7.699 price point for its mix and match offers, et cetera. And so I think in a consumer environment where we are going to see trade down and a little bit more defensive consumer in terms of their spending habits, Domino's is extremely well positioned from a top line perspective. Number two, wheat and cheese prices should actually be pretty good tailwinds this year, whereas they were pretty big headwinds last year. So, I think margins are in a better place in terms of the outlook, at least for Domino's and the pizza players, relative to some of the other names in the industry. And then three, because they don't participate in third-party delivery, it all comes down to driver availability and staffing. And so I think, at least I'm a little more hopeful than some others, that they're going to be able to address those issues, in an environment where, perhaps employment isn't as tight. And so if they can get those delivery drivers, that's going to drive some nice top-line momentum as well.
This is just pure speculation on my part, but I wonder how you think about M&A as well. I think of a brand like QSR, Restaurant Brands International. They're missing pizza in their portfolio. I know it's been talked about on and off, but do you think of Domino's as a potential takeover candidate?
I don't. I think their size and scale is probably prohibitive for someone like a QSR or even other players. I think if there is M&A, I would be surprised if it's in the pizza space.
Oh, where would you expect it to be?
Yeah, I think we'll probably see it a lot more in full service, where valuations are much more attractive relative to historical levels. Darden there is the primary consolidator in the industry. As you know, that's one of my other hot picks today. And so if I were to expect any kind of activity, it would be Darden potentially acquiring someone.
Let's talk Darden. It's had a pretty solid year. Trading close to where it was in the beginning of the year, a nice 26% gain over the last 3 years. How much more upside do you think a chain like this has?
Well, I think given their valuation at in terms of the low teens EV/EBITDA, and given the kind of visibility we have in terms of top and bottom line growth, I do think that even if you just maintain the current multiple, the increase in profitability this year and 2024 should result in double-digit types of gains for the share price. Now they have the scale in terms of that full service category. They're by far the largest player. To be able to offset the margin headwinds better than anyone else within that category. And they're very well positioned from a value perspective as well, given their brands. The diversity, gives them a little bit of a shield in terms of if one brand underperforms, others will outperform. So there's a lot of very attractive features that Darden possesses.
And lastly, just in the last 30 seconds, I mean, if we get some sort of consumer slowdown but no relief on the cost side, do you think that these picks are best suited to outperform in that environment?
I do, yes, and that's really what I have in mind when I talk about these picks.